The inverted yield curve, the most reliable recession indicator in finance, fired its warning over a year ago. But GDP is growing at over 2%, and stocks just closed at record highs, so everyone says it's broken. It's not. They're just reading it wrong. And that's great news, because the right read says you're making money through 2027. Here's the track record everyone's pointing at. Normally, the longer you lend the government money, the more interest you charge. When that flips and short-term bonds pay higher interest than long-term bonds, that's an inversion. And for decades, an inversion meant a recession was coming. But here's the eerie part most people miss. The recessions never hit while the curve was inverted. They hit after the curve snapped back to normal. 1990, 2001, 2008, 2020. Every time, the snapback, the steepening, was the final tripwire. And a recession followed typically within 12 months. That's exactly what just happened. The curve inverted, then steepened back out more than a year ago. The tripwire fired, and then nothing. GDP running over 2% year over year. Corporate profits at near all-time highs. The Dow just closed at a record. So Wall Street split into two camps. One says the most famous signal in economics finally broke, throw it out. The other says the ambush is coming, it's just late. Both camps are staring at the same chart, and both are wrong. Because a yield curve can steepen in two completely different ways, and only one of them has ever come with a recession attached. The yield curve is just the difference between what the government pays to borrow for 2 years versus 10 years. Typically, when you loan money to the government for longer, you require higher interest to compensate for the additional risk. That's why in a normal yield curve, long-term rates are above short-term rates. You subtract the short-term rate from the long-term rate and you get a positive number. Do that over several months or years and you get the yield curve. Now occasionally, short-term rates exceed long-term rates. When you do that math, you get a negative number. That's what's called an inverted yield curve. But the spread between the long-term rate and the short-term rate can turn back positive in two ways. Way number one, the short end collapses. 2-year yields are heavily influenced by the Fed, so when they're falling fast, it means the Fed is slashing rates. And the Fed doesn't slash rates because everything's fine. It slashes because something is already breaking and it's trying to put the fire out. This is called a bull steepening because lower yields are bullish for existing bond prices. They rise as rates fall. Way number two, the long end rises. 10-year yields are set by investors betting on the future. When they climb, investors are pricing in years of growth and normal rates ahead. Nobody demands a higher return on a 10-year loan because they expect a depression. This is called a bear steepening because rising yields are bearish for existing bond prices. Higher yields mean existing bond prices fall. You end up with the same chart shape. Just the opposite story. One is a fire alarm, the other is a growth signal. Now run the tape on every steepening that actually delivered a recession over the last 35 years or so. 1990, the Fed cutting from nearly 10% into the Gulf War downturn. 2001, the Fed slashing from 6.5% as the dot-com bubble imploded. 2007, cutting from 5.25% as the housing market cracked. 2020, COVID and emergency cuts straight to zero. Every single one was a bull steepening. The short end collapsing while the Fed panic cut into a fire. That's the actual tripwire, not the steepening itself. The reason for it. So what about this one? Since the curve bottomed out in mid-2023, the 2-year yield has fallen about 0.77 points. The 10-year? It's risen 0.62? Do the math on the total move and it splits roughly 55 to 45. Barely half of it is the short end falling, and the Fed's cuts have been measured from around 5.5 down to the mid-3s. Not a panic in sight. The other 45% is the long end rising. Investors pricing in growth. No recession steepener in the modern record has a component like that, not one. So if you've been sitting in cash waiting for the crash this chart supposedly promised, the chart isn't saying what you think it's saying. And it gets better, because the alarm didn't just misfire. Everything that's supposed to accompany it is missing too. Think about what a recession actually is. It's not a chart pattern, it's a chain reaction. Credit gets tight, corporate profits get squeezed, Companies start cutting to survive, layoffs cascade, spending collapses, and the whole thing feeds on itself. Which means before every recession, the same warning lights come on. Profits roll over. Jobless claims spike. The dominoes start falling months before the headlines catch up. So look at the board right now. Corporate profit margins aren't rolling over. On an after-tax basis, they're at 12.4% of GDP, the second highest ever recorded. And they're still climbing. Profits grew to $4.42 trillion on an annualized basis last quarter, up from $4.35 trillion in the prior quarter. The first domino in every recession is profits getting crushed. That domino isn't wobbling, it's welded to the floor. Jobless claims the count of people newly filing for unemployment are running around 215,000 a week, historically low. Before 2008, before 2020, before 2001, that number was spiking months in advance. Right now, it's flat. Now, I'm not going to pretend the labor market is perfect. June added just 57,000 jobs, and the April and May numbers were revised down by 74,000. Unemployment sits at 4.2%. Companies aren't firing, but they're not hiring aggressively either. It's a low-fire, low-hire economy. But here's the twist. That soft jobs report might be the most bullish data point of the month. Because the market's big fear this summer wasn't a recession, it was the opposite. Inflation running at 4.2% and a Fed that might start raising rates again. Back in June, markets put the odds of a September hike at 64%. That threat is what rattled stocks. Then the weak jobs number hit, and those odds dropped to a coin flip. And our new Fed chair, Kevin Warsh, stood up at the ECB forum this week and said inflation expectations are easing and he feels no urgency to raise rates. One honest caveat. The consumer is tiring. Spending's been revised down, savings are being drawn on. This growth is being carried by business investment, especially the AI build-out, not by shoppers. That's a narrower engine. It's also not how recessions start. Recessions start with profits breaking and layoffs cascading. And neither is anywhere on the board. So the alarm fired, and nothing that follows the alarm is happening. Which raises the real question. If the curve isn't warning you about the next 12 months, what is it telling you? Here's the part of the yield curve almost nobody uses. The curve doesn't just describe today, it leads. The New York Fed's own research, the academic standard on this, puts the lead time at 4 to 6 quarters. Credit conditions today shape growth a year from now because the loans, the projects, the hiring decisions being priced right now take about that long to show up in the economy. So take today's curve, positive, steep, and steepening for the healthy reason, and slide it forward 12 to 18 months. What it's historically pointed to is growth holding up into mid to late 2027. Not a boom. Let's be honest about what this actually means. Consensus forecasters see growth around 2% through 2027. Nobody serious is calling for fireworks. But that's the thing most people get wrong about markets. Growth doesn't need to be spectacular, it needs to not be a recession. Because think about what's actually priced in right now. Half the market is braced for a crash that the mechanism says isn't coming. There's a mountain of money sitting in cash, earning less every time the Fed cuts, waiting for an entry point that never arrives. When a feared recession simply fails to show up, that money doesn't get a discount. It gets a decision. Keep waiting or pay up to get back in. That's the setup where ordinary investors quietly come out ahead. Not despite the scary headlines, because of them. The headlines are what's keeping everyone else on the sidelines, and if you're on those sidelines, run your own numbers on what waiting has cost. Say you've been holding $50,000 in cash since the curve inverted, waiting for the all clear. Money markets paid you well for a while, 5% at the peak. But the Fed's cut 175 basis points, so that yield is sliding toward the mid-threes and inflation is running 4.2. Your safe money is now losing purchasing power every single month. Meanwhile, the market you were waiting to buy cheaper just closed at a record. That's the trap in waiting for the crash. The crash isn't the only way to lose money. Standing still is the other one. It's just quieter about it. And this is exactly what the curve's shape is telling you. The long end rising means the bond market, the most cynical, unsentimental money on earth, is positioning for years of growth at normal rates. Bond investors don't do hope. When they demand 4.5% for 10 years, they're pricing an economy that stays out of the ditch. Now, the window. The curve gives you visibility about 12 to 18 months out. That's the mechanism. And that's why this read runs through mid to late 2027, not forever. Past that, it depends on where the curve goes next. And there's one hand that can slam the window early. If inflation refuses to come down and Wash is forced into a hike cycle after all, the short end rises, the curve flattens, and this entire setup starts to unwind. That's the risk with a name on it. One more piece of honesty. Even inside the strongest market regimes on record, 5 to 10% corrections happen. Regularly. That's not the crash finally arriving. That's the toll the market charges you to stay on the road. So let's put the whole picture together. The most famous alarm in finance fired. Everyone heard it. And then they split into two camps. The ones who threw the signal out and the ones still bracing for impact. But the signal was never broken. It was never late. It just wasn't saying what they thought it was saying. Every recession steepening in modern history was the Fed panic cutting into a fire. This one is nearly half the bond market pricing in growth. Different mechanism, different message, and every warning light that should be flashing alongside a real fire alarm, profits cracking, layoffs spiking, a panicking Fed, is dark. Now, I'm not asking you to take this on faith. A thesis you can't kill is just a belief. So here's exactly what would prove me wrong. 3 things, in sequence. Jobless claims start spiking and stay elevated. Not one bad week, a sustained climb. Corporate profits roll over from those record margins, and the Fed stops cutting on its own schedule and starts panic cutting. The short end collapsing the way it did in 2001, 2008, 2020. That's the recession sequence. All 3, every time. Right now, none of them is happening. If they start, this thesis is dead, and I'll be the first one on this channel to say so. But until the data says otherwise, the read stands. The curve isn't warning you, it's handing you a window. 12 to 18 months of visibility that most people are too scared to use. If this changed how you read that chart, subscribe. I track these signals every week, and if this one starts breaking, you'll hear it here first. And drop a comment. Are you in the market right now or still in cash waiting? Because here's the shift that matters. Most people spend their whole lives reacting to charts they don't understand, hiding in cash every time a red line makes the news, buying back in after the recovery already happened. The people who come out ahead aren't smarter. They just ask one question nobody else asks. Not, what did the chart do, but why did it do it? You now know the difference between a fire alarm and a growth signal. Between a Fed that's panicking and a bond market that's positioning. Most of the people staring at that same chart don't. The window is open through 2027. The crash crowd will still be waiting when it closes. And keep the momentum going. Watch, is the US planning a $50,000 gold revaluation? It's on your screen. Remember, this isn't personal financial advice, it's education so you can build your own plan. See you in the next video.